Welcome to The Explainer. I'm absolutely thrilled you're here today because we're going to look at something that literally has the power to change your entire financial future. We're unpacking the ultimate beginner's guide to demystifying the stock market and, more importantly, building real, lasting wealth. If you've ever felt like the stock market is just, I don't know, this secret club with its own complicated language, well, you're exactly in the right place. Today, we're breaking the whole shebang down so you can finally take control of your financial destiny. So I want to kick things off with a number that might actually shock you. 50%. Recent research shows that the wealthiest 1% of Americans own a staggering 50% of all stocks. But the bottom 50% of folks, they own just 1%. Crazy, right? So why exactly is that gap so massive? Well, it really comes down to one fundamental truth. Just saving your money in a traditional bank account, it's simply not enough to build wealth anymore. You have to own assets that actually grow. The wealthiest people, they completely get this, and they use the stock market as their main engine for wealth creation. And here's exactly why they do it. Historically speaking, the stock market has returned an average of around 10% per year. 10%! That is a massive wealth-building opportunity. Yet somehow, 38% of American adults are completely missing out on it right now simply because they don't own any stocks at all. So the whole goal of our explainer today is to get you into that market confidently, so you can finally stop leaving that incredible opportunity on the table. Okay, let's dive right into this. Section 1. What are stocks exactly? Before we talk about making money, we really need to strip away all that intimidating financial jargon. So what actually is a stock? Simply put, a stock is a security that represents ownership of a fraction of a corporation. When you buy a stock, you aren't just trading meaningless pieces of paper or, numbers blinking on a screen. You are literally buying a slice of a real breathing business. Think of it like a giant pizza. If a company has 1,000 slices or shares and you own 100 of them, you own 10% of that entire company's assets and future earnings. You're a shareholder. You are an actual owner. Now, as a new investor, it's absolutely crucial to understand the core difference between the two main ways you can invest, stocks and bonds. As we just said, when you buy a stock, you're taking an ownership stake. That means you're taking on a bit more risk, sure, but you also get the potential for much, much higher returns. If the company crushes it, you crush it. Bonds, on the other hand, are totally different. When you buy a bond, you aren't an owner, you're a lender. You're basically giving the company a loan, and they promise to pay you back with interest. It's lower risk, and if the worst happens and the company goes bankrupt, bondholders get in line way before stockholders to get their money back. But, and this is a big but, for long-term wealth creation, stocks have historically outperformed bonds by a wide margin specifically because of that ownership premium. Now, what's really interesting here is exactly how you actually put money in your pocket as a stock owner. There are two primary ways this happens: dividends and capital appreciation. Dividends are pretty straightforward. They're direct cash payouts distributed to you straight from the company's profits. Think of it like a nice little cash bonus just for being an owner. Capital appreciation, meanwhile, is when the actual price of your shares increases over time as the company grows and becomes more valuable. So if you buy a share at $10 and it goes up to 11, well, you just made $1 in capital appreciation. Moving right along to Section 2, the power of compounding. Let's talk about growing your wealth. Understanding what a stock is gives you the foundation, right? But this next concept, this is what will actually make you wealthy. We're talking about the sheer mathematical magic of compounding. Just think about this incredible example. If you invest just $5,000 a year, which, by the way, breaks down to a little over $400 a month, and you do that consistently for 30 years at that historical 10% return we talked about, you don't just end up with $150,000 you put in. No way. You end up with a nest egg of over $900,000. Literally. That's enough to completely change your retirement. That is compounding in action. It's simply your money making money, and then that new money making even more money. It snowballs. The key here isn't dropping a massive amount of cash all at once. It's just giving the math decades to work its magic without interrupting it. Which brings us to Section 3, surviving the market and handling volatility. Now, I have to be honest with you, the journey to wealth is definitely not a straight line up. To get those sweet long-term returns, you absolutely have to survive the short-term bumps. Just listen to this famous quote from Charlie Munger, the brilliant investing partner of Warren Buffett. He said, "If you're not willing to react with equanimity to a market price decline of 50% 2 or 3 times a century, you're not fit to be a common shareholder." Ouch. That is a massive gut check, right? I mean, a 50% drop sounds utterly terrifying, but Munger is basically telling us that major market declines are just a totally normal feature of investing. They're a feature, not a bug. And because of that, panic selling is literally the biggest mistake you can make. Fun fact, even legendary world-changing companies like Amazon, Apple, and Berkshire Hathaway have all suffered massive 50% drops at some point in their history. The market just goes through cycles. It goes down, sure, but historically, it always recovers and pushes even higher. Actually, if you play it too safe and avoid stocks completely just because you're scared of a drop, your money just sits there and gets quietly eaten alive by inflation. So, what's the absolute best defense here? Keep a solid emergency cash fund. That way, when the market inevitably takes a dip, you're never forced to sell your stocks at a loss just to pay your bills. Okay, let's look at Section 4, How Beginners Can Start. Here is your step-by-step blueprint. So the crucial point is, how do we actually take that first step? We know what stocks are, how compounding works, and that we have to brave the drops. Here are 4 super practical steps to actually take action. First up, determine your approach. Do you want to pick individual companies yourself, or maybe you want an automated robo-advisor to build a widely diversified portfolio of index funds for you? Honestly, both work beautifully. Second, decide your investment amount. Really, just start small and focus on consistency. Third, open an account. You can open a standard brokerage account, or, if you're saving for retirement, a tax-advantaged account like an IRA is a great move. And finally, step 4, buy your stocks. Spread your money across different companies to diversify your risk, and just hold on to them for the long term. Now, if you're sitting there wondering exactly how much of your savings should be put into the stock market versus safer fixed income investments like bonds, here's a fantastic, incredibly simple trick called the Rule of 110. It's basically a shortcut. You just subtract your age from 110. The number you get, that's the approximate percentage of your money that should be in stocks. So, to put that into perspective, if you're 30 years old, 110 minus 30 means you should aim to have about 80% of your investments in the stock market. This helps maximize your growth while you still have plenty of time on your side. As you start allocating that money, I do want to gently warn you against some classic beginner traps. First, try to avoid making emotional decisions. Don't buy just because everyone else on social media is, and definitely don't panic sell when the news gets a little scary. Also, please do not try to get rich quick by day trading. Seriously, leave the short-term trading to the professionals. Another big one, never invest money you're going to need in the next 5 years, like for a house down payment. And finally, never ever use borrowed money, what's called margin, to buy stocks. The stock market is an amazing wealth engine, but it's for sure not a casino. So when you strip away all the noise, right? The blinking red and green lights on those financial TV channels, the overly complex jargon, this is the absolute core of what we've learned today. True wealth building is a gradual process. It requires immense patience, relentless consistency, and real long-term thinking. It's not an instant payout. Actually, scratch that, it's the exact opposite of an instant payout. But if you respect the process, it is without a doubt one of the most reliable ways to completely secure your financial freedom. So, I'm going to leave you with this one final provocative thought. Are you ready to take your very first step toward building lasting wealth today? Because you absolutely have the knowledge and the blueprint to get started right now. If you enjoyed this explainer and want more beginner-friendly content about stocks, investing, business, and building wealth, make sure to like this explainer, subscribe to the channel, and turn on notifications so you don't miss the next one. Thanks for hanging out with us, and we'll see you next time.